For more on this, we're joined by Christopher Tahir in Kuala Lumpur. He's a senior market strategist at Exness. Welcome back to the programme, Christopher. Now, we've seen similar scenarios in recent months. Are investors being too optimistic about a potential peace deal?
Hi, first of all, thank you for having me. Currently, investor is very dependent on what is being updated in the news. For instance, what Trump says through his social media will be one of the key sources that investors will closely follow. However, with the pessimism that is growing in the market, Trump has just posted that the deal will come in the near future, which actually caused the price to plunge yesterday. So in this case, we are very dependent on what is being updated in the headlines.
So if the Strait of Hormuz fully reopens, how much further could oil prices fall and how quickly can we expect supplies to return to those pre-war levels?
So when we talk about the oil price recovery, in this case, recover to the pre-conflict level, it will be highly dependent on the return or the recovery of the supply. With the current supply that is about 90% lower from pre-conflict era, it actually caused a little bit more complication because the disruption itself is divided into three phases. The first phase is the facilities that were shut down properly, meaning that were not forced to shut down. This kind of supplies will return in the next 2 to 3 weeks. However, there are some that is a little bit more complicated, which will require longer time, about 3 to 4 weeks. And then there is another one that is like highly complex ones, and probably with some destructions in the facility, which will require like up to 6 months. So in this case, it will be highly dependent on that. But if we are looking at these numbers, we are looking at about the price of oil can go down to about $80 or maybe $75 if this recovery really happens according to the projection. So with the current price sitting at around $88 to $90, that number seems to be possible.
Meanwhile, gold and silver have continued to rally even as markets cheer signs of de-escalation. What does that tell us about lingering investor concerns?
So if we talk about risk-reward premium to gold, it has been priced in quite significantly in the past. So the current trade of silver and gold is not about the conflict premium anymore, but it is more towards the monetary policy, and in this case, the strength of the US dollar. So what the market is looking at now is not the conflict development only, but they are focusing towards this development of the monetary policy in the near future. So with the current inflation that is a little bit more elevated, we can see that there is a potential that the Fed can hold the interest rate a little bit longer. So of course, we try not to be like overly optimistic that the Fed will hike the rate in the near future, although we see that the number of the expectation has grown significantly, especially for a hike in December. So we see that with this condition where yesterday the job market data was a little bit muted, we can see that the expectation of the market is slightly receding. So it will be highly dependent on the next releases in the US markets.
Christopher Tahir in Kuala Lumpur, great to have your analysis. Thank you.